Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another show. And don't we have a lot to talk about this week with all the movement in the stock markets, and then also the commodities. Lots of interesting things happening there as well. And then any stock codes you'd like me to have a look at, we'll get them ready. We're going to go through those in the second half of the show. As always, everything today, general commentary only, doesn't take your personal situation into account. So having been through all that, let's get into this week's first chart. And starting off with the ASX 200. So the ASX 200, it's had one of its quickest reversals ever from an all-time high to a 3-month low. Took just 6 days. So is this about to get a whole lot worse? I'll talk more about this in a moment. And then over in the US, I've got a statistic that will really make you think about what comes next. We'll get to that in a minute. But before we do that, let's start with this latest price action of the ASX 200. As I said in the intro, this has been one of the quickest reversals for the ASX 200. So from that all-time high, it hit this 3-month low on Monday, with this spike low on Monday. It's since been a bit of a rebound before just coming back in the last couple of days. I think the biggest fear now is that the situation in the Middle East escalates and causes an ongoing sell-off or even a crash. But rather than jump to the worst case scenario, I think the best thing to do is to assess the price action that we currently have and then manage it accordingly. As it stands, we have a fast move from above the moving averages to below. So that in itself doesn't constitute a bear market. So yes, it's unpleasant, causes losses, no one enjoys it, but it's not a bear market, it's volatility. There's a good example from just a few months ago. So we just look over at this period here during October, November. The catalyst was a bit different, but it was the same sort of structure from above the moving averages quickly to below the moving averages. This is all about the fear at this point. There's always fear about something. The fear at this point was about an AI bubble, but the price action was similar. Like now, though, it was a fast decline. And people were fearful it was going to get a whole lot worse. But, of course, a bear market didn't develop. Prices recovered. So does that mean we should be looking for prices to quickly recover now? Well, of course, nobody knows. But the point is that volatility doesn't necessarily lead to a bear market. And in fact, in most cases, it doesn't lead to a bear market at all. What's going to be important now is the next rebound. What does the next rebound look like? Is it going to be like do we get a shallow, lackluster rebound, or and if we get that, well then that suggests that selling in the rally is occurring, which isn't good, or do we get a strong V-shaped recovery like what we saw back in April last year, big sell-off, then that V-shaped recovery, and so we really need to see what that next rebound looks like. So that's what I'm watching for now. Does the structure shift? Does the structure shift from bullish to bearish? And I think the next rebound does tell us a lot about that. And by that, what I mean is, do we start seeing consolidations below the moving averages, where prices rally, they consolidate below the moving averages, but don't really get back above them? And then when you get that sort of situation, then prices can be prone to breaking down again. I think that's the key going forward. And for now, that hasn't happened. We don't have that consolidation below moving averages. We don't have a secondary breakdown. All we have is a volatile sell-off from above to below the moving averages. It's just not enough time to get the structural change which is associated with bear markets. So the structural change that I'm referring to is when you get these shallow rallies below moving averages, that's where vulnerability is. But we don't have this structure at this point. There's certainly scope. There's certainly scope for more selling in the near term. certainly scope for more selling, I think, in the near term. And that's because fear and volatility are key drivers of emotional selling. And that's a big factor in fast declines. When you get volatility, you get fear, and emotion comes in. That's really what can drive those fast declines. I think there's a good possibility we get a test of the November low, possibly over the next week, whilst fear is running so high that we can't discount that possibility of another sharp sell-off down towards the November low. But what is interesting to consider is whether this could possibly ultimately prove to be part of a big range. So, for instance, like, could this period through here since around August, could this really be part of a big sideways range where you get those swings from either side of the moving averages several times before then potentially higher levels in the months to come? And when you consider the extent of the rally off April's low, like, look at the strength of that rally off April's low. When you do that, this would, if we did get trading within a range over several months, that would potentially set up a proportional consolidation in both price and time. So, big rally over many months, and then a consolidation in a big range over many months. It's sort of one of the scenarios which could be considered other than a market crash. And this is one of the things I think a lot of people forget during those big bullish phases, and that is that big moves usually lead to lengthy consolidations. When you step back and you look at this chart, so let's just compress this a bit. We're going back to the COVID lows. When you look at this, you see, it's full of rallies and consolidations, or bigger rallies and then longer consolidations, rallies and consolidations, rallies, consolidations. It's the way markets step higher over time. Of course, some of those consolidations turn into lengthier bearish phases, as we saw during 2022, 2023, but ultimately it's the way markets move higher, and I doubt this time will prove any different. Let's just have a quick look at some of the key components of the ASX 200. So starting with the materials index. And so the materials index is where we find all the big mining stocks. So this has been a quick 16% decline, but remember to keep the decline in context with what came before. And in this case, what came before was an 82% rally from last April's low. So in that context, a 16% decline really it's not out of place with such a big rally. Remember what I said about big moves leading to lengthy consolidations. I think that's probably what we're looking at here in the materials. I think the potential for a multi-month consolidation is certainly now in play. Now we have that decline, which does cut that near-term momentum. But the overall trend, it still remains bullish. This is not a bearish structure. There's still rising moving averages. Price is still above the 100-day moving average. It hasn't shifted into a bearish structure. I think for an ongoing decline in the ASX 200, I think the materials would probably need to reverse. You'd probably need to see overall weakness in the materials to see the ASX 200 go into a lengthy decline. Coming over to the financials, of course, the other big sector in the local market, prices have come back to the moving averages. So a strong period during February, back to the moving averages. Now, the key here is, will the financials be able to stabilize around the moving averages? Good signs of that so far this week, of stability around the moving averages. If a larger sell-off was to occur below the moving averages, well, that would open the potential maybe for a big range developing. Again, like I was talking about in the ASX 200, could this be part of a big ongoing range? Either way, we don't have a bearish structure in financials at this time. So this still appears to be a consolidation within a larger upward trend. And lastly, just quickly going over to the equal weight, ASX 200 on an equal weight basis. This is where the smaller stock and the larger stock are, of course, weighted as being equals. And this has very much been the weak link, or the weakest link, in respect to the ASX 200. The consolidation below these moving averages has now given way to a sharp decline, and it highlights where much of the losses have been this week. It's been in the mid caps and the small stocks, not as much in the big caps, although of course there has been losses there too. And this is how larger ongoing declines can develop. This price action, which we're seeing here in the equal weight. Let me just compress this a little bit. I will go over to just like, keep in mind this price action. So we got from the high, a sell-off below the averages, a consolidation below the averages, a secondary sell-off. It's how some of these bigger declines can develop. Let me just find the example I'm looking for. It's like it's here, isn't it? So there's an all-time high, there's a sell-off, there's a consolidation below moving averages, then you got the secondary decline, like are we here now? And then you get the shallow bounce towards the moving averages and you get an ongoing decline. It's not to say that will play out this time, but this is how those longer declines can develop. So it's I think that this is a risk. This is a risk with the current structure, that something like 2022 could start to develop. Hasn't, it may not, but I think that's the risk. That's the risk with the present price structure. So we shouldn't be complacent and just assume the market will quickly snap back. It may well do so, but don't be complacent. This price action in the equal weight, it is a serious point of concern. I think the next rally will be critical. Is it a strong rebound, or is it a shallow bounce? I think that will tell us a lot. I've been selling stocks that have hit their exit levels this week. I'll continue to do so. That said, I'm not panic selling by any stretch. My selling has been systematic. It's been planned. It hasn't just been, the market's down 2%, I better sell. It's like, is there a reason? Is it systematic? Is it planned? And then the sale goes ahead. Otherwise, it's holding stocks which many continue to be in profit. So I'm also continuing to hold those stocks that are above exit levels, letting the price action determine whether I sell. I'm not rushing to sell based on headlines or what others are doing. And as I've been saying over the last few weeks, I'm not in a rush to do any buying. It's not a dip I want to steam in and start buying. I'll let others try to pick the low. My primary objective here is managing risk and preparing for the next upward phase whenever that may come. Okay, we're going to go over to the US market next. Got the US small caps after that, the local small caps. We'll go through all the commodities, look at your stock codes. That's all still to come. US market next. But look, if you're getting some value, please click that like button and leave us your comment. Just tell me what you think. Are we heading for a crash, a consolidation, or a rebound? What do you think is coming next? But clicking that like button, please, it makes a big difference. Tells YouTube people are watching. YouTube shows other people. Helps me heaps, so please do that. All right, S&P 500. Well, S&P 500 is showing signs of losing its footing. So twice in the last week and a half, it's broken down from this multi-month range. So we've talked about this range quite a bit in over the last few months, and it started to break to the downside. So you can see the first break was on Tuesday a week and a half ago, thereabouts, and then prices rallied, and then we had another break just on Monday. But on both occasions, there hasn't been that all. On both occasions, prices snapped back. You can see prices snap back on both occasions after seemingly breaking down. But on both occasions, there wasn't that all-important follow-through buying. So we had a rally which didn't attract further buying. Prices came back. Another rally didn't attract further buying. Prices are coming back. So the rallies have been sold. The other point of vulnerability is that there's now a clear sequence of lower lows and lower highs. You can just see that through this period, lower lows and lower highs. So every time the market has tried to rally, the sellers have been waiting to push it back. It's this sequence of lower lows that really concerns me in the near term. When I've said that the S&P 500 looks like it's losing its footing, I'm looking at the lower lows, and what they suggest, it's a sign that the sellers are starting to overwhelm the buyers, and it sets up the potential for a sharp decline. So I think a break below Monday's low. So Monday's low, I think it's a critical level. I think a break below Monday's low will likely trigger a fast move, probably to like around the November low or lower. I think the break below Monday's low, it does set up that potential for that fast move. And we're also dealing with a fearful market, and fearful markets are prone to sharp breakdowns. Coming over to the Nasdaq, it's got a very clear line in the sand. Look at the series of lows from that's early February, and there are several of them. There's several key lows since early February. The Nasdaq has resisted several attempts to break lower over the last few weeks, and so far it's been holding firm around this line. But I think the inability to rally, just like we were discussing with the S&P 500, the inability to rally on the last couple of occasions has rebounded off this support region. I think that increases the risk of a breakdown. As we often discuss, prices are vulnerable when they consolidate below moving averages. That's what the Nasdaq has been doing, and you'll see that as well as consolidating below the moving averages, you'll see prices have also formed a tight trading range. You just see this tight trading range over the last 6 or so weeks. And the thing with tight trading ranges, when you get this compressed price action, it often leads to a strong move when they break. Now, we can't be sure whether it's going to break to the upside or the downside. You never know until these patterns actually break. But I think the risk of a break to the downside is increasing by the day. Now, it's important to note that if we do get a breakdown, if the Nasdaq does in fact break down, it doesn't necessarily mean a bear market has started. As I discussed with the ASX 200, volatility usually doesn't lead to a bear market. So this is where having a plan and not automatically expecting the worst, I think it's just so important. I think a break below this cluster of lows would quickly see the Nasdaq move down to and probably below the this low point from November, and then it's a case of continuing to assess the price action. I think that's the near-term risk that we're looking at. But it does take a break below this support to trigger that potential sequence. Coming over to the Magnificent Seven, prices have continued to coil up, continuing to coil up below the moving averages, and this is an ongoing consolidation. And this ongoing consolidation below the moving averages, again, it makes the Mag 7 vulnerable. Like the Nasdaq, we've got a cluster of lows that have been providing support. As I said last week, the risk is a break below this cluster of lows sets off a fast decline. We've already got a series of lower lows. You can see this series of lower lows in the Mag 7, of course, with the lower highs as well. So that's the risk here. I think to disengage that risk, the Mag 7 and the Nasdaq for that matter, really needs to have a strong update, really needs a strong update that retakes the moving averages, and then it needs to attract follow-through buying. That's what's been absent in these various attempts to take the market back higher. It hasn't had the follow-through. Lastly, in the US, we'll just have a quick look at the equal weight ASX, or the S&P 500 on equal weight basis, and it's broken below its 100-day moving average. I've got the 50 and 100-day moving averages on the chart. On Thursday, it broke below the 100-day moving average. So this is now a broad-based pullback. It's not just a rotation out of big tech. There's more to it than just that. We're seeing this broad-based weakness across industrials, across the equal weight. It's not just a tech story. But it's also important to note that this is still not a bearish structure. It's we've been, and this is the thing with the US. We've been discussing the cross currents in the US market since, look, I think it was back in early February. We're talking about the cross currents, and it's the bearish currents that now seem to be getting the upper hand, and that's what we're seeing in the Nasdaq and the Mag 7. But that doesn't mean a full-blown bear market is starting. And this is something really, I think, important to take on board. Let's just go back to the S&P 500. I'm going to put this onto a weekly chart. I'm going to compress this. Let's go back to the GFC lows. There's the GFC lows back in 2009. Now, this is like you go from left to bottom left to top right, and there we have got a giant advance in the S&P 500 over that period. But what about the pullbacks? How many times do you think the S&P 500 has been down 5% from its highs? And of course, it's down 5% from its highs at the moment. So how many times in this period has the S&P 500 been down from its highs? And the answer is 32. This is the 32nd time the S&P 500 has been down 5% or more from its highs. Now, each of those earlier declines came with new fears, came with new talk of crashes and the like, but ultimately prices recovered and went on to new highs. Now, some of those 5% declines were just blips along the way. Others were more meaningful or bear market corrections. But nonetheless, it's been a case that many of the times these 5% declines are quite benign. Actually, of those 32 declines, I think the average decline was saying like 7.2% or something like that. So many of them just passed by and are long forgotten. So yeah, don't get swept up in worst case scenarios, because much of the time the fear of the moment passes by, things move on. By all means, be prepared for more volatility, and I think follow your plan. Don't let others' fear become your fear. For me, that means holding on to profitable positions, wide trailing stops, and selling stocks that hit their exit levels. Managing risk, protecting capital is key. It's about having a plan to respond to the price action, not to the fear. Okay, let's now move over to the small caps. We'll go to the US small caps first, the Aussie small caps, then the commodities, then your stock codes. So get those stock codes ready. I'm sure there's lots of interesting stocks to look at in the current volatility. But of course, that wraps up the free section. If you're not a strategy session member, there's a link below. Click that, come on in, doesn't cost you very much. And we're going to go through a whole lot of other interesting things during the course of the show. So, okay, let's go over to the Russell 2000.